You look at the news. Inflation is up, the debt clock is spinning, and the world feels fragile. You see an ad for gold bars, and you think, I need something real to protect my family. You think you're buying insurance, but there's a catch. You aren't buying safety, you are paying a fear tax that pauses your wealth building for decades. I'm going to show you why the safe haven might actually be the riskiest place for your money. I'm obsessed with how money actually works in real life, not in the brochures they send you. Quick thing before we get into the numbers. I'm not a financial advisor, and this isn't personal financial advice. I'm just a curious soul who reads way too many historical return charts and hates seeing people get sold fear. If you're making big money moves, talk to a professional who knows your specific situation. Here is the scene. You're scrolling. You see a chart showing the dollar losing 98% of its value since 1913. Then you see a shiny gold coin that has held its value since the Roman Empire. Your brain instantly goes, paper is fake. Gold is real. I need to trade the fake stuff for the real stuff before it's too late. That feeling? That impulse to grab something solid? That is exactly what the industry is banking on. The gold industry doesn't sell you metal. They sell you a cure for anxiety. But the medicine is incredibly expensive, and today we are going to look at the receipt. Let's start with the immediate math problem nobody puts in the commercial. When you buy a stock or an index fund like the S&P 500, the fee to get in is basically zero. You buy $100 of stock, you own $100 of stock. If you sell it 5 minutes later, you have roughly $100 back, minus maybe a tiny penny spread. But when you buy physical gold, coins, bars, jewelry, you are stepping into a retail store. There is a spot price. That's the price you see on the news ticker. Let's pretend it's $2,500 an ounce, but you can't buy it for $2,500. You have to pay the dealer premium. You might pay $2,650 or $2,700. Then, if you turn around and try to sell it back to that same dealer the next day, they won't pay you $2,650. They won't even pay you the spot price of $2,500. They'll pay you the buy price, which might be $2,400. Quick math. You bought for $2,700. You can sell for $2,400. You are instantly down 11% the second the transaction clears. In the stock market, losing 11% is a correction or a bad year. In the physical gold market, losing 11% is just the entry fee. You aren't investing yet. You're just clawing your way back to zero. And this gets worse if you buy those collectible or numismatic coins. The markup there can be 30%, 40%, or 50%. You are buying a story about rarity, but the market value is just the metal. The villain here isn't the metal itself. The villain is the friction. The system is set up so that the middleman makes the guaranteed profit, and you take the risk of holding the heavy rock. So, strike one. You start the race 10 steps behind the starting line. But let's assume you hold it long enough to cover the spread. Here is the philosophical problem that destroys your compound interest. There are two types of assets in this world. 1. Assets that do things. 2. Assets that are things. When you buy the S&P 500, you are buying a slice of the 500 largest companies in the US. You are buying Apple selling phones. You are buying Amazon shipping boxes. You are buying Visa processing payments. These companies have thousands of employees waking up every morning trying to figure out how to make more money, lower costs, and invent new stuff. They pay dividends. They reinvest profits. The asset is alive. It is an engine that generates cash. Now, look at gold. If you buy an ounce of gold and put it in a safe, and you come back in 50 years, what do you have? You have 1 ounce of gold. It didn't have babies. It didn't pay you a dividend. It didn't invent a cheaper way to be gold. It just sat there. Think about that. For gold to go up in value, someone else has to be willing to pay more for it later. That's it. That's the whole mechanism. It relies entirely on someone else's fear or desire. For stocks to go up, the companies just need to make money. Here is the catch. When you buy gold, you are betting against human ingenuity. You are betting that a static rock will be worth more than the collective innovation of the entire economy. Historically, that is a terrible bet. And I know someone is screaming at their screen right now. But the dollar is losing value. Gold protects purchasing power. Let's look at the quick math on that because the data is absolutely brutal. I want to show you the difference between protecting your money and growing your money. Because they sound the same, but one leads to a comfortable retirement and the other leads to working until you're 75. Let's go back 30 years. Let's say you had $10,000 to invest in 1996. Scenario A, you were scared of the world, so you bought gold. Scenario B, you were optimistic or just boring, so you bought the S&P 500 and reinvested the dividends. 30 years later, roughly 2026, your $10,000 in gold? It grew. Gold was around $380 an ounce back then. Now it's roughly $2,500 depending on the exact day you check. Your $10,000 turned into roughly $65,000. You're thinking, hey, that's not bad. I made money. Sure, you kept up with inflation and made a little extra. You didn't lose. But now let's look at the factory. Your $10,000 in the S&P 500 with dividends reinvested. It didn't turn into $65,000. It turned into roughly $200,000. Wait, check that. Depending on the exact start or end months, it's often closer to $180,000 to $210,000. That gap? That $135,000 difference? That is the fear tax. You paid $135,000 for the feeling of safety. That money isn't just numbers. That's 10 years of retirement. That's a paid-off house. That's your kid's college education. You handed it over because you wanted to hold a shiny bar instead of a digital statement. And here is the kicker. Volatility. People buy gold because they think it's stable. It's not. Gold has dropped 30% or 40% in value multiple times in history and stayed down for decades. Between 1980 and 2000. 20 years. Gold basically went down or sideways. If you bought the peak in 1980, you didn't break even for 28 years. Imagine waiting 28 years just to get your money back. That's not a safe haven. That's an opportunity cost nightmare. Now, I have to address the Mad Max argument. This is the final boss of gold marketing. The pitch goes like this. The stock market is a Ponzi scheme. The dollar is going to collapse. The grid is going down. When the apocalypse hits, your electronic shares will be worth zero, and I'll be rich with my gold coins. Let's play that out. Seriously. If the world truly collapses, I mean grid down, no banks, total anarchy, what is the value of a gold coin? You can't eat it. You can't burn it for heat. You can't shoot it to defend yourself. You can't take it if you get an infection. In a true collapse, the currency isn't gold. The currency is beans, bullets, medicine, clean water, and skills. If I'm starving and you offer me a shiny coin for my last can of Spam, I'm going to laugh at you. Or worse. Gold only has value when a civilization exists to value it. It's a luxury store of value. It works when there is a market, a price, and a buyer. If the market disappears, gold is just a heavy rock you have to carry while you run. Ask yourself, are you prepping for the end of the world or are you prepping for retirement? Because if you're prepping for the end of the world, buy canned food and a water filter. If you're prepping for retirement, buy productive companies. Trying to use gold for both usually means you fail at both. You're too poor to retire, and you're too hungry to survive the apocalypse. So if the math is bad and the apocalypse logic is shaky, why do smart people still buy gold? Because of our lizard brains. We are evolved to value things we can hold. For thousands of years, wealth was land, cattle, and metal. Digital ownership of a corporation is a brand new concept for our biology. When you hold a gold coin, it feels permanent. It feels like nobody can take this from me. When you look at a brokerage app, it feels like a video game score. It feels fragile. The system knows this. That's why financial apps use gamification, confetti, and bright colors to make you trade more. But the gold sellers use weight, history, and gravitas to make you hoard more. There is a psychological comfort in the zero line. Gold rarely goes to zero. A company can go bankrupt and go to zero. But here is the catch. We aren't buying one company. When you buy the S&P 500, you are buying 500 companies. The chances of all 500 going to zero is basically the chances of the US government and global economy ending. And if that happens, see the apocalypse chapter. Your gold won't save you anyway. You have to override your biology. You have to trust the math over the weight. Quick check. If having 0% gold keeps you up at night, buy some. But buy it for the right reason. Don't call it an investment. Call it a prescription. You are paying a fee lower returns to buy a psychological sedative better sleep. If that helps you sleep, fine. But know the price of the pill. So is gold essentially garbage? Should you never own it? Not necessarily. It has a role. But that role is not growth engine. That role is chaos insurance if you absolutely must own gold because you hate the Fed or you love history or you just want to feel like a pirate. Here is the deliverable. Here is the framework to do it without destroying your future. Rule number 1. Cap it at 5% to 10%. If your net worth is $100,000, keep $5,000 in gold. No more. Why? Because if gold goes to the moon up 10x, that 5% becomes 50% and you save your portfolio. It worked as insurance. But if gold does nothing for 20 years, which it often does, you only dragged down 5% of your money. The other 95% was working in the factory, building your wealth. Rule number 2, physical or ETF. If you want it for the apocalypse feeling, buy physical coins. But realize you will lose 5 to 10% on the spread immediately. If you want it just to balance your portfolio, buy a low-cost gold ETF. You avoid the spread, you avoid the safe storage fees, and you can sell it in 1 second. Rule number 3, rebalance. This is the only way gold actually helps you. If stocks crash 50% and gold jumps 20%, you sell some gold high and buy stocks low. If stocks soar and gold drops, you sell some stocks and buy gold. This forces you to buy low and sell high automatically. Pause the video. Look at your total net worth. Calculate 5%. Do you have more than that in gold or crypto or collectibles? If the answer is yes, you aren't diversified. You're betting the farm on a rock. And the math says the house usually wins that bet. Here's the reality. Investing is boring. It's supposed to be boring. Gold is exciting. It's shiny. It has stories about treasure and collapse and empires. But excitement is usually expensive. The boring path. Owning productive companies, reinvesting dividends, and waiting is how normal people get wealthy. The exciting path. Hoarding metal and waiting for the world to burn is how you end up with a heavy safe and a light bank account. The catch wasn't that gold is fake. The catch was that safety has a price tag, and over 30 years, that price tag was hundreds of thousands of dollars. If this video saved you from putting your life savings into a shiny rock, Tap the like button so the algorithm shows this to someone else before they make a mistake.